43% of all the physical silver stored on Shanghai's exchange vaults vanished in just 2 weeks. Not over a quarter, not over a year. 43% gone in a fortnight. According to warehouse data published by the Shanghai Futures Exchange and tracked by Commodity Intelligence Services, inventories crashed from above 1,100 tons at the start of October 2025 to 663 tons by late in the year, the lowest level in 21 months. And the drain did not stop there. By early February 2026, Shanghai Gold Exchange Vault data showed combined Chinese exchange silver holdings had fallen further still, to levels representing a 91% decline from their peak in 2020. The number 663 tons sounds abstract until you understand that every ton leaving a vault represents real, refined physical metal that someone took delivery of and removed from the global trading system. It does not come back easily. It does not come back quickly, and the people pulling it out appear to be in no mood to return it. By the end of this video, you will understand 3 things that most people watching the silver market right now do not. First, you will understand precisely why a 14% premium for silver in Shanghai above the LBMA benchmark in London is not a curiosity or a pricing anomaly. It is a mechanical signal that the global silver market has fractured into competing physical islands with no clean arbitrage connecting them. Second, you will understand what a single regulatory document published in Beijing on October 30th, 2025 actually changed about the structure of global silver supply, and why the ripple effects of that document are still accelerating months later. And third, you will understand why the lease rate on silver, a number that almost nobody outside of bullion banking ever looked at before, is telling you something about the condition of LBMA vaults that the headline inventory figures alone cannot. The data is public. The sources are verifiable. The picture they form together is one that the mainstream financial press has only partially assembled. Silver closed at $90.10 per ounce on the most recent first notice day, according to Trading Economics, while CME Group data simultaneously showed 10,526 contracts, representing 52.63 million ounces, standing for March delivery, against just 86.13 million ounces of registered inventory. Silver trade. That coverage ratio is thin, uncomfortably thin, and the reason it matters is not simply the absolute number, but the trajectory that produced it. COMEX registered silver inventories have declined by 31% since October 2025, falling below 90 million ounces for the first time in years, a steady and persistent fall, not a sudden one-day event. In the 30 days ending March 11, 2026, according to Vault monitoring data, registered silver flows were negative by 23.9 million ounces, while total vault flows across registered and eligible categories recorded a net outflow of 50.2 million ounces. The COMEX Stress Index, a composite measure combining coverage ratio, inventory trend, paper leverage, and vault outflows, stood at 84 out of 100 as of March 11th, against an all-time high of 88, with an inventory depletion estimate at current withdrawal pace of approximately 70 trading days. Total COMEX silver inventory currently stands at around 440 million ounces, but only approximately 124 million ounces are registered, meaning less than 30% of reported silver can actually be delivered. Improved. The distinction between registered and eligible silver is one of the most important and least understood concepts in this market. Eligible silver meets COMEX specifications and sits in approved vaults, but the owner of that metal has not warranted it for delivery. It can be converted to registered status, but only if the owner agrees. The exchange has no claim on it. When people say COMEX has 400 million ounces, they are conflating metal that is deliverable with metal that is merely stored in the same building. The paper-to-physical ratio measured against registered inventory alone currently stands at approximately 7.4 times, according to Vault monitoring data published through March 11th. In January 2026, which is not even a major delivery month, COMEX processed delivery demand totaling between 33 and 40 million ounces in the first 2 weeks alone, representing roughly 26% of registered inventory disappearing in a single week. That figure represents a 7 to 10 times increase over historical January delivery averages. Bullion Hunters February 2026 then delivered 5,036 contracts, 25.18 million ounces, representing the highest February delivery volume in modern COMEX history. The first 3 days of that delivery period alone accounted for 54.9% of the month's total, suggesting industrial users and institutional buyers were front-running further tightness, rather than rolling to later months as they normally would. Silver trade. Across the Atlantic, the LBMA picture is no less striking. According to data from the London Bullion Market Association, total silver holdings have fallen nearly 40% since 2021, marking one of the steepest declines on record. Substack. The lease rate, the annual cost of borrowing physical silver in the wholesale market, is the most honest stress indicator in the London system, because it does not benefit from any headline smoothing. Under normal conditions, 1-month silver lease rates hover around 0.3 to 0.5%. In October 2025, those same rates spiked to nearly 40%, signaling extreme scarcity of immediately deliverable silver. Substack. By January 2026, the rate had stabilized at around 7 to 8%, still more than 15 times its historical norm, reflecting a market that remains severely short of physical metal. Gold-silver. This is the moment to address the most important counter-argument head-on, because it deserves a serious answer and not a dismissal. The argument runs as follows. Falling COMEX and LBMA inventory figures do not necessarily represent a global silver shortage, because exchange vaults are only one segment of the total above-ground silver supply. Metal moves between custodians, refiners, industrial warehouses, and ETF vaults constantly. Lower registered inventory at COMEX might simply mean metal has been re-warehoused elsewhere rather than consumed. This is a legitimate point, and it is partially correct. According to LBMA analysis, elevated lease rates indicate tightness in deliverable inventory, a temporary supply-demand imbalance, rather than an absolute disappearance of silver from the planet. Metal that is locked in 1,000-ounce bars in London vaults cannot instantly become deliverable at COMEX without logistical conversion. That nuance is real. However, the counter to this counter-argument lies in the simultaneous depletion across all major exchange systems at once. COMEX registered inventories are down nearly 70% since 2020, LBMA vaults have lost around 40% of their holdings, and Shanghai inventories have fallen to their lowest level in a decade, all at the same time. Improved. When 3 major exchange systems on 3 separate continents all drain simultaneously, the "it's just moving between vaults" explanation requires that metal is piling up somewhere that nobody can see and nobody is reporting. That is possible. The data we have, however, does not support it. Here is what nobody is connecting clearly enough. On October 30th, 2025, China's Ministry of Commerce published a regulatory notice that received almost no coverage in Western financial media at the time. Effective January 1st, 2026, the ministry replaced a quota system that had governed Chinese silver exports since 2000 with a new licensing framework, bringing silver under the same regulatory structure as strategically sensitive materials, including tungsten and antimony. Trading key. Under the policy that took effect on that date, only large, licensed, state-approved companies with an annual silver production capacity of 80 tons and a credit line exceeding $30 million can export silver. Improved China also published a list of just 44 companies approved to export under the new rules. Trading key. 44. In a country that controls an estimated 60 to 70% of globally refined silver output, the export corridor has been narrowed to 44 approved entities, each of which must separately obtain a government license valid for 2 years. China exported 4,600 tons of silver through the first 11 months of 2025, against imports of just 220 tons. Improved. That net export figure is staggering. It means China was a massive net supplier of refined silver to the rest of the world for most of last year. The new licensing regime did not stop those exports on day one. What it did was introduce administrative friction, approval timelines, and qualification criteria that hundreds of small and mid-sized exporters simply cannot meet. The requirements effectively block hundreds of smaller and mid-sized exporters, who have long served as key suppliers to global industrial users and silver refiners. Substack. The effect is not a complete ban. It is something more surgically disruptive, a slow squeeze on the pipeline that made Chinese silver available to London, Zurich, New York, and Mumbai on short notice. The parallel Beijing drew on explicitly mirrors its earlier approach to rare earth metals. In 2010, China began licensing rare earth exports, not banning them, just requiring approvals and paperwork that systematically constrained supply. The result over several years was a restructuring of global industrial supply chains that gave Chinese manufacturers decisive cost advantages in sectors from smartphones to defense electronics. Silver is following the same architectural template, with one significant difference. Unlike rare earths, silver has no commercially viable substitute in solar photovoltaic cells, in electric vehicle power systems, or in the high-frequency connectors inside AI data center infrastructure. A typical 5-megawatt solar installation requires approximately 350 to 400 kilograms of silver for its electrical contact systems. And global solar capacity additions approaching 200 gigawatts annually mean photovoltaic manufacturing alone demands in excess of 14,000 tons of silver per year. That demand does not negotiate with a licensing regime. It simply cannot stop. Since 2021, the global silver market has run in deficit for 5 consecutive years, with industry estimates pointing to cumulative shortfalls of roughly 820 million ounces between 2021 and 2025, nearly equivalent to a full year of global mine production. FX Street. The Silver Institute, which compiles the World Silver Survey annually using data from Metals Focus, confirmed this structural picture. The Silver Institute forecasts a 6th consecutive deficit in 2026 of 67 million ounces, with the balance still relying on above-ground inventory drawdowns, even after accounting for a 1.5% increase in total supply. CME Group. 6 straight years of the world consuming more silver than it produces, drawing down stockpiles that were never designed to function as a buffer reserve. The cumulative math of that is not recoverable in months. It takes years of new mine production coming online, years of industrial substitution, or a price high enough to destroy enough demand to rebalance the system. The 1980 silver episode is the historical comparison that commentators reach for reflexively, and it deserves careful treatment because the parallel holds in some respects and fails in others. In 1979, the price of silver based on the London fix jumped from $6.08 per troy ounce on January 1st to a record high of $49.45 on January 18, 1980, an increase of 713%, as Nelson Bunker Hunt and his brother William Herbert accumulated over 100 million troy ounces of silver and several large futures contracts. MEXC. On January 7, 1980, in response to the Hunt's accumulation, COMEX adopted Silver Rule 7, which placed heavy restrictions on the purchase of commodities on margin. As the price fell back, the brothers were unable to meet their obligations, and on March 27, 1980, Silver Thursday, silver prices collapsed. MEXC. That episode was resolved in a matter of weeks because the supply constraint was artificial. One family with leveraged positions, not a structural industrial deficit built over half a decade. The difference today is structural rather than speculative. The Hunt squeeze was created by a concentration of ownership attempting to corner the market. What the data describes in 2026 is a convergence of genuine physical demand, industrial, monetary, and strategic, colliding with a supply system that has been running below replacement for 6 years and has now had its largest single export corridor locked behind a licensing regime. In practice, the global silver market has split into 3 separate pricing islands: Asia, primarily China and India, North America, centered on COMEX, and Europe, centered on LBMA. Each region is now competing for whatever metal it can control. FX Street. The 14% Shanghai premium that this video's title describes is not an arbitrage opportunity waiting to be closed. It is the quantified cost of that fragmentation, the price the physical market attaches to the friction between those 3 islands. The Bank of England angle matters here in a way that has gone largely undiscussed. The LBMA operates as the world's primary over-the-counter silver trading hub, and London vaults underpin the unallocated silver system used by the 4 major London Precious Metals Clearing Limited member banks for net settlement. By 2025, LBMA's eligible silver stocks had shrunk to approximately 155 million ounces, while floating annual demand was running at 900 million to 1.2 billion ounces. Gold-silver. The Bank of England, as the prudential regulator of the bullion banks that sit at the center of LBMA clearing, has a direct supervisory interest in whether those institutions can meet physical delivery commitments. No public statement from the bank has addressed this directly, but the lease rate data, which reflects the private cost of borrowing metal in the London market, is the closest thing to a real-time stress indicator that the system produces, and it has been shouting since October. London vaults did see a historic inflow of nearly 54 million troy ounces of silver in October 2025, the largest monthly addition in at least 9 years, drawn by the arbitrage opportunity created by market tightness. Bullion hunters. That inflow eased some of the acute pressure. The lease rates fell back from their 40% peak, but they never returned to normal. The structural drain continued. 3 specific things to watch in the coming 48 to 72 hours. First, the CME Group publishes its daily vault report for COMEX registered and eligible silver each afternoon, available at cmegroup.com. The number to track is the daily registered change. If registered outflows continue at recent pace, the 30-day net of minus 23.9 million ounces, the coverage ratio will compress further ahead of the March contract final delivery period. If instead, registered inventory stabilizes or shows conversion from eligible, that is the first signal that physical supply pressure is easing. Watch for it specifically on the afternoon reports this week. Second, the Shanghai Gold Exchange publishes weekly vault inventory data every Friday. The last reported figure was at multi-year lows for combined SHFE and SGE inventories. Consecutive large weekly outflows of 50 to 100 tons, paired with stubbornly positive premiums, are not noise. They confirm that onshore physical demand in China is accelerating procurement, not merely rolling positions. Improved. If this Friday's SGE weekly report shows another significant outflow, while the premium remains above 10%, that is confirmation that the drain has not abated. If inventories stabilize and the premium narrows below 5%, that is the first real evidence that the arbitrage is being arbitraged away. Third, the March COMEX silver contract reaches its final delivery settlement this month. The CME Group publishes daily delivery notices through its Metals Issues and Stops MTD report, available publicly on their website. With 10,526 contracts standing for March delivery, representing 52.63 million ounces against 86.13 million ounces of registered inventory, any single large delivery day that brings cumulative March deliveries above 60 million ounces will test the practical limits of what the registered pool can absorb without triggering eligible to registered reclassification at scale. Silver trade. That reclassification process is legal and normal, but it requires custodians to act, and the timing matters. Watch the daily delivery report. Here is what the data establishes as fact. COMEX registered silver inventory has fallen 31% since October 2025 and currently supports a paper-to-physical ratio of approximately 7.4 times based on CME vault data through March 11th. Shanghai exchange vaults have experienced their largest recorded weekly outflows and stand at multi-decade lows by some measures, according to SHFE and SGE official data. China's Ministry of Commerce implemented a licensing regime for silver exports on January 1, 2026, restricting the export corridor to 44 approved state-certified entities. The Silver Institute, using Metals Focus data, projects a sixth consecutive annual silver deficit in 2026, meaning the physical market will again consume more metal than it produces. And the one-month silver lease rate in London, which reflects the private cost of borrowing immediately deliverable physical metal, remains approximately 15 times its historical norm, even after retreating from its October peak. What the data suggests directionally is this: the Shanghai premium at 14% is not a rounding error. It is the market's clearest real-time signal that physical silver is valued materially differently in the world's largest industrial consumer than it is on Western paper markets. Whether that gap closes by metal flowing east through the narrow approved export pipeline, by Western prices moving higher to reflect physical tightness, or by both simultaneously, is what the next several weeks will determine. The data does not tell you the date or the price. It tells you the direction of pressure. The pressure is not easing. Thank you for watching. The question I want to leave you with is this: if China's silver export licensing regime produces the same multi-year supply chain restructuring that its rare earth export controls did after 2010, which industrial sectors outside China are most exposed, and which governments have published any credible strategic stockpile plan for silver? Think about that carefully before answering. The links to every source cited in this video, CME Group vault reports, SGE inventory data, China Ministry of Commerce notices, Silver Institute survey data, and LBMA reference material, are in the description. This video is for educational purposes only and does not constitute financial advice. All figures should be verified independently using the primary sources linked below before any financial decision is made.